All right. Good day, everyone. Welcome back to Not So Nice Show. I think we have been hectic for January because we have been working very hard for our Stock Plus 2022. And after that has concluded, we are now much free to actually do a little bit of updates on one of the latest quarterly reports from our big tech. So it used to be FANG, but now it's MAMAA. So of course, what is MAMAA? We will actually go through the updates. So basically, it will be about Microsoft, Amazon, Meta, platforms, Apple, and also Alphabet. So it will be in two parts. So we'll cover two companies in the first part, and then the remaining three in the second part. So without further ado, let's just go straight in what happened to all of these big tech companies. Of course, without proceeding, just a little disclaimer, what we share here is just our opinion, our thoughts, and our so-called what we actually see from the numbers. It's our opinion only, so do not take it as a buy, sell, or hold decision, and do your due diligence before you actually make any investment decision. Right, I'll kick it off with the first company for the update, which will be Alphabet. So you might not be familiar, but actually Alphabet is the holding company of Google, which controls and owns a lot of apps that we really utilize and require on a daily basis. Right, so just to give you guys a very brief update or schematic diagram of what Google's business is. Basically, they are mainly in the advertising business. So if you use Google Chrome or you use Google search engine to search for stuff, sometimes you'll come across website links that get prioritized, and there's a little ad button or disclaimer on the site. So basically, companies who want their company links or website to appear first, they'll pay Google a fee to get prioritized in terms of the search results, and that is one of the key main revenue generator for Google in terms of Google search. There's also YouTube revenue, which is also part of the most profitable business of Google as well. And then there are also the smaller portion of it, which is Google Property, Network Properties, and also the Google Suite of products, and then Google Cloud as well. Right. So I think we have come into an age where company share prices actually move up or down depending on whether they beat, miss, or match analyst estimates, right? So it's no longer about growth. Personally, for me or for KayaPlus, we still really rely on growth. If it's a good growth, we will still continue to invest in the company. But sometimes in this world that we live in, if you miss analyst estimates, you get penalized. So we'll talk about more about a company later that actually miss a little bit of some analyst estimates. But for Google, everything has been smooth. They beat EPS, earnings per share. They even beat in terms of the revenue. And then the only thing that really missed is the so-called traffic acquisition cost, which is coming at 13.4 billion against analyst prediction of 12.9 billion. So I think overall, it was a very good result for Alphabet Inc. And if you look into the so-called year-on-year comparison, the revenue actually increased 41%. Right? Google is relatively a big company, but for 2021, things have been doing very well for Google Search and so YouTube. Net income increased 88.8% year-on-year, which is, you can see in terms of the search percentage, is much more than what Google has been achieving for the past few years. So there's a little bit of operating leverage coming into play that actually made 2021 fiscal year a very, very good year for Google. And if you strip down one of their fastest growing vertical, which is Google Cloud, you can see that they are also growing very well, which is 45% year-on-year as well. And the so-called losses also narrowed. So potentially, I think in the next few quarters, you would see Google Cloud actually contributing to some sort of operating profit of Alphabet Inc. Next, of course, we talk about operating leverage, boosting the revenue and also profit. So the return on assets and also the return on equity also get bumped very high. ROE is at around 30%, and then the ROA is actually at past 20% for 2021. And one scary thing about Google is that you really can't imagine how great is it the business is in terms of the cash generating capabilities. If you can see the blue line here denominated, how much cash from the operations or from core businesses has actually been generated for Google. And in terms of the investing activities, they have been, I think, quite stable in terms of reinvesting into their companies, properties, like data centers to support the cloud growth and also R&D as well. Right. I think last but not least, just a very kind reminder that how strong Google is in terms of the competitor, in terms of website visits. Google.com is still the most visited website. Second place, YouTube is also part of the Google family. And if you take the other players like Facebook, Wikipedia, all of them add up, you still lose out to Google.com and YouTube.com together. So you have to imagine how strong Google is in terms of website visits and also the traffic. Right. And I think one of the last things that you should consider and know about is that they are going for a 20-for-1 stock split. So right now, Google shares is roughly trading around 2,000 plus per share. If the stock split actually goes on, it will actually make the share price very, very cheap in terms of affordability, but not in terms of PE lah. So roughly, you'll be seeing Google share price trading at around 100 plus bucks if the so-called split actually proceeds by 2022 of July 1st. So you make Google shares more affordable, and the Robinhood or the smaller investors can actually buy into the stock. May potentially push up due to the affordability, but not due to a valuation point. Valuation, you will have to rely back on the so-called updates that we have provided you in terms of the latest quarterly and also fiscal year earnings of Google. Right. And I think you can see the market has been very choppy. So I think it's really up to you guys to guesstimate which is a good entry price if you want to invest in the Google stock, or if you want to wait for the stock to actually split first before you actually start to invest. Right. So it's really up to you. But in terms of earnings, maybe I'll pass it to Chun Bing. Are you actually excited and happy for Alphabet's performance?
Yeah, I'm excited for Alphabet performance, but I won't take the Google stock splits as one of the plus point when I wanted to actually invest into the stock. Got nothing to do at all besides giving you an opportunity to go inside with a much lower entry price. That's it. But other than that, the highlight should be Google Cloud. It's the first time they start to see lesser loss ratio, which is a very important thing, because without that, Google is also all about advertisement revenue, which is very similar to the next company that we are going to cover, which is Facebook. And they have actually recently rebranded or renamed into this Meta Platform Inc. Right. So I will do a quick sharing about how Facebook business models works. Basically, they are everything about ads. So whatever you did, whatever service that you get from Facebook, actually you're contributing to some of your personal behavior, and it lead to some of the recommendation come back from Facebook. And then how Facebook make the money is they use all this information and get all the merchants to pay for it. And this is a big part of it. And then beside Facebook platform, they also own Instagram. And the one that haven't really monetized yet is actually WhatsApp. And most importantly, other than that, all these things has been going pretty well until the latest quarter, where you can see they are not doing well in terms of EPS because they actually missed the performance, which is actually estimated by the analyst by 4.4%, right? And then, but this is just about the headline. If you look into the entire year of performance, actually the EPS actually rise 36% year on year. So when we look into all this sharing from a quarterly perspective, you should always think, take a step back and see whether this is what really happening or not. So to be fair, it did miss the estimate, but if you see the entire performance, Facebook still relatively strong in terms of the EPS. And then the next important one is their share. The headline is actually covering that the latest quarter, their net income actually fall 8% year on year. But one of the things that we wanted to highlight, if you look into this in details, quarter 4 of 2020 is actually one of the best performing quarters for Facebook or Meta. And then if you compare the historical high against the same quarter, but it's just 1 year later, it might not be fair because there are so many factors that can be added in for FY 2020 due to pandemic and whatnot, all these things being accelerated. So yes, it fall from net income perspective in terms of the quarterly revenue, but then I mean quarterly net income, but then we should see it from a full picture view. It did perform, it's just not as good due to one-off kind of good performance last year. But out of all these scary headlines, this is the one that actually hit the investor the most. This is the first time in the history that the DAU, or the daily active user, actually fall from Facebook in 18 years. So usually every single quarter they has been reporting I have more and more daily active users. This is the first time that Facebook have this kind of threat, and then of course due to a lot of competition, and this actually make a lot of investors worry that their growth might not be able to continue. But if you zoom into the details, actually from others angles, their family daily active people's their monthly ads actually is still doing quite well. It's just this particular quarters it didn't increase. So it's just need to think about it. Facebook has been going up every single quarter in terms of daily active user. How many more countries you can go, how many more market that you can actually tap on. They got to be some stop. So it's also logical for Facebook to actually maybe slow down and then try to actually tap on other potential revenues, right? So in terms of the advertising revenue, it remained strong even though the Reality Labs business unit is making widening losses. But other than that, ads has been actually bringing a lot of revenue for Facebook, and if you can see from 2019 to 2021, it's almost 80% jump in just 2 years. So all these things is a very positive stats. Don't just get scared away due to a few drops in the quarterly basis. And of course, from a cash flow perspective, excellent, 65% increase year on year. And like it or not, Facebook still the most popular social network, but to be fair, there are a lot of other social medias that's catching up, especially in the younger generation. So this is the key turning point that you should look Facebook or Meta from now on, whether they can continue to get user excited, especially the younger generation, which is going to spend more and more into the platform, or they are going to lose to platform like TikTok, and eventually this also reflected inside their ads revenue. So this is all the key takeaway about Facebook. Not so well from a quarterly perspective, but if you look into the facts and figures, it's not a bad year though. And then of course, one of the key things that announced by the CEO or founders is basically they are putting a lot of bet into metaverse, but of course, how far they can go with metaverse is still a question mark. So maybe I pass to Jupan to sum up this thing, and then what is their view on Meta, this company?
So I think what you said is very correct in terms of performance-wise. They actually had a very good fiscal year. It's just that in terms of matching the analyst estimates, they are a little bit behind. And to be also fair, the drop in DAU is particularly in the US and also Canada markets. If you zoom out a big picture, Asia users, they are still going at the single healthy digit lah. But at the end of the day, I think what makes or much we should be concerned of is actually how Apple's so-called approach when it comes to managing user data, which Meta claims is going to impact their so-called ad revenue significantly. So that should be your so-called key investigation, whether how huge of an impact that would impact Facebook in the coming quarters. And from there only you guesstimate and also make a stance whether the drop in terms of share price of 25% is an overreaction or not. If it's not, then come up with an antithesis and why you should actually shun away from Meta platforms or from Facebook as your investment thesis. So of course, I think at the end of the day, we also have put out our so-called opinion and also our comparison between two of the largest advertising tech companies in the world, which is Meta and also Alphabet. So it's previously or originally a premium article, but we decided to make it to for free to read for the public. So if you are interested on our take and comparison between both Meta and Alphabet, you do check out the link in the description box. It's actually available for you guys to read, and we won't spend more time to actually go through it because you can actually read it up. And if you have questions, you can also contact us in the comment section or at the social media platform as well. Of course, last but not least, big tech stocks are actually still quite relevant, but you need to actually choose the relevant ones and the prospective ones to help you invest. So just to shout out what we have actually achieved for StockPlus 2021, we actually did 24.5% return. We basically beat out Nasdaq and Dow Jones. We are just a little bit behind from S&P 500. And if you're still lost and don't know where to invest, come and join us for StockPlus 2022, right? So it's very affordable. It's just $249 if you just subscribe to it. But if you want more in terms of services, in terms of the premium article that I saw just now, you want to actually get access to other future offerings and services that we are providing, you can also check out Premium Club, which actually bundles StockPlus together and the future StockPlus as well. So you get access to StockPlus 2021 and also 2022 if you sign up for Premium Club. And here is basically the snapshot of what we offer: premium articles, premium videos and analysis, and also other so-called tailored articles and analysis to help you understand the companies before you actually do due diligence before you invest. So I think that's about it. We'll see you guys in part 2. So here you have it. You see that we will actually come up with part 2 to cover the remaining 3 companies in the next video. I think we'll actually put the box in a link below there so that you can actually proceed to part 2. So I think head on to part 2, and we'll see you guys there. Take care. Bye bye.